Hey guys, what if you could control a stock like Apple or Google or Amazon or whatever your favorite stock is? What if you could control that stock for a fraction of the cost? Would that be interesting? Of course it would, right? So that's what we're going to talk about today in the video. I'm going to keep it short. If you're new here, welcome. I'm Bruce Marshall. Thanks for stopping by my channel. If you're in the market for conservative option income strategies for your retirement account, for your nest egg, you're in the right place. So let's jump right in. We're looking at Apple here on the screen, and the way that we would do this is through a LEAP option. And you probably heard the term, you may have used it before. If not, we're going to talk about them and kind of go over what they are. So a LEAP option, L-E-A-P, is a long-term equity anticipation security. Long name, easy to use, right? Basically, it's a call option, right? We can use calls or puts if you're bearish. Calls are bullish, puts are bearish, right? But it's just like buying a call option on Apple. But let me show you the difference in how it works. So we'll go to our trade tab here, and if you notice that we have weeklies, here are the days until this option expires: 1 day, 4 days, 6 days, 7. Here's the monthlies: April, May, June, July, August, September, etc. Right? Well, if we go in and let's just say we go out to May, this is when I'm recording this, it's in March. But let's just say we want to buy an option on, and let me take some of these strikes away, kind of clean it up a little bit. Let's just say we want to buy a call option and we want to go to May for whatever reason. And you generally, this is very ballpark, but you generally, if you want a bullish exposure, you want to get around a 70 delta option. If you don't know what delta is, don't worry about it. I've got other videos and I can certainly help you with that. But let's just, for comparison's sake, that's a 240 strike price, right? So if we want to buy a 240 strike price option, call option, these are calls over here and these are puts over here. If we want to buy that $240 call option on Apple, it's going to cost us about $20 a contract. Now, one contract covers 100 shares of stock. So that's your discount right there. So if you're going to buy 100 shares of Apple at $252, that's going to cost you $25,200 for 100 shares, right? Here, one contract, this 240, any of these, controls 100 shares, right? So this costs you 20 bucks. Would you rather spend 25,000 or would you rather spend 20? Well, obviously, less is more, but is it? The question is, if you buy this sounds great, it's $20, right? Well, this expires in 50 days. So this is like, you're holding a stick of dynamite and the fuse is lit because the time is, eating up that option. And Apple, in this case, would have to move very quickly, but your $20 could go to 30, 40, 50, 60, whatever, if Apple were to really get in a big move higher within this time frame. So how do we overcome that, lit fuse on this short time frame? Well, it's easy. You go out further in time, and that's where the leaps come into play. So if you look down the list here, we've got April, we've got May, June, July, August, etc. Here's December. I've got my drawing tool over here on this monitor. This year, 18 December 26. We've got December 27. These go all the way out to December 28. Look at this. This is 995 days from now, right? See right there? So that's 3 years. We're approaching 3 years on this option. Well, that's pretty cool. Instead of having that little short $20 lit fuse option, let's go way far out in time. A lot can happen in 3 years, right? Apple, you think, or Google, or whatever your favorite stock is. If you're bullish and you have a longer term perspective, long term view, you want to go out as far as you can, right? So let's compare the price, and I'll start right here. We'll go with this year, December 26, and we'll stick with that $240 price, strike price. And you can see we go from the earlier one in May was 20 bucks. This one's 37. getting a little more expensive. If we go out a year later, the 240 is about 54. So it's going up in price, right? So if we go all the way out here to December 28, again, this is almost 3 years from now. If we go to the 240 strike price, 240, it's going to cost us about, around $65 a contract or whatever. It's more expensive, but guess what? You still control 100 shares now for 3 years instead of, in that case, it was 50 days. So, this is 100 shares for 3 years. Again, a whole lot can happen in 3 years. This is a very inexpensive way to get a lot of exposure there. And again, let's do some quick math. And so let's just compare. So you buy 100, if you buy 100 shares of stock, I'm trying to write with my mouse here. Let's just, for round numbers, let's just say 25. It's going to cost you $25,000, right? If you took that same $25,000 and now we're going to divide that by the price of this LEAP option, we're going to divide that by, let's just say 65 to have a round number. You're going to get about 385, about 385. That equals 385, but remember, each one contract equals 100 shares. So that's basically 3.85 contracts. So let's just say 4 contracts times, 65 is going to give you about 20, about around, this is ballparking, 25,000. So this, you're going to control 400 shares for the same amount of money versus 100 shares. That's a big benefit, right? 4 to 1. That's pretty cool. I mean, it's a huge difference there, right? So that is amazing. You get so much leverage there, right? And I'm not saying that's the best thing to do, but I'm just giving you an example. So why would you not do this? Well, there's a little more to it than that. Let me clean this up a little bit. So if you notice here, and I don't want to get deep, I've done a lot of videos and things on the Greeks. So I told you delta, this is a 70 delta. What that means is that that option will give you about the same movement. If the stock moves $1, a 70 delta is going to give you about 70% of that move, right? So it won't move dollar to dollar for dollar typically. So you get 4 times the amount of shares that you control, but they might not move as directly as owning, for example, if you own 400 shares, right? Now the other side, that's kind of the you just need to know that, right? The other thing, if we do go way up in, over 3 years time, you get a lot more bang from this because you have less money committed, right? Capital committed right here. So in that case, you do get a much more bang for the buck than outright owning the share. So there's a give and take to each. And again, I'm just giving you a very high level overview here, right? Because people ask, well, why won't everybody do that? Because on the surface it makes sense. It does, but again, you need to know, how the options work. Is just like any call option or any put option. It's going to have theta decay. Things need to move quickly. We're doing this long term. The LEAP is 1 year option. Is when the LEAP category starts, is 1 year out to 3 years, right? But that's a long time, and it gives the stock time to work, and it allows you to manage your portfolio in a maybe a little more efficient way if you want to do that. Now again, you got to know the pros and cons, right? And one of the other things, if you own LEAP options or any call options, you do not get the dividend. So on this one, on Apple, it doesn't pay a huge dividend anyway, but the point is you don't get the dividends. They don't have voting rights because you don't actually own the shares. You just own an option to control the shares, right? But again, it is also a way, if you have a lot of stock and say you work for Walmart or Home Depot or whatever, and you've got a giant pile of stock and you want to get rid of some for some reason, whatever, you could sell a big piece of big number of shares and replace that as a stock substitute for a third of the cost if you bought a leap because you just wanted to keep exposure over the next say 2-3 years. Just throwing out an idea. There's different ways to think about this, but leap is a fantastic tool. It's so efficient for us to use. You have defined risk. Now think about it. Think about this too. This is and I'm saying $65. Just let's say $65. If you bought one at 65, that's actually 6,500 because remember that's 100. One option contract controls 100 shares, so 6,500 bucks. Now, if you held this for 995 days and the stock went down, this goes to zero. You lose all of that. But if the stock goes to zero, they go out of business. Apple's going to go out of business. I don't think so, but for argument's sake here, you lose 25,000. If it goes to zero here, you lose 6,500. Again, pros and cons. There's good and bad with each side of it. The thing about this too, also, if you buy this and it's $65 and tomorrow or next week or next month or 6 months from now you decide, Apple doesn't look that good anymore, or I need the money, I want to do something else, you just sell it. It's daily liquid. Any day of the week you can just sell it, right? So notice this, 995 days out, there's 57,000 contracts. No, that's extrinsic value tree. Let's look and see if there's any contracts out there. People will go out a long way in time and buy and sell these. Yeah, there's 1,427 contracts have already traded 995 days out from now. So again, it's a very, very good tool to get exposure for planning for the future and things like that. So I wanted to talk about leaps and go over that. It's a good way to think about it. There are a lot of pros and cons. The pros far outweigh the cons, in my opinion, if you know what to look for. I'm glad to help you with that. I have a live trading room. We talk about this stuff, and we set these trades up all the time. I'll put a link down below if you care to join us. We've got a free trial, or I think it's $7 trial for 30 days or something like that. Come in there and check it out. It's really worth it. Also, I have a free newsletter. I'll put a link down in the description, and always talking about good stock ideas and concepts and things to look for, right? But back to the leaps. If you need help on this, let me know. Just remember that when you have I didn't get into a lot of detail on the Greeks and all that kind of stuff, but it does have some theta decay on it. You can get a tremendous amount of leverage, a good thing, but again, just kind of be aware of what you're doing. But the biggest key to all the options, people are always thinking that if I buy this option, I'm tied up for 900 days. No, you buy it at 10 o'clock in the morning and you sell it at lunch if you want to. And so all day long, you pay $65 for it, right? And in a week, it's worth $75. And you say, you know what? I don't, this is fine. I want to take my little win, or I decided I don't like Apple anymore, whatever. Or let's go the other way. It goes to $55 and you say, oh, I'm nervous. I'm down 10 bucks. I'll just sell it. So totally liquid. That's the key. Totally liquid. But take these concepts, and obviously, there's many ways you can get information. I'm glad to help you. In fact, leave some comments down in the bottom of this video if you want me to do a deeper dive into how they work and that type thing. I just wanted to skim the surface on this with you. We can go deeper if you want me to. Let me know. Leave a comment down there and I'll do a video for you. And let me know if I can help. So I'll put links for everything in the bottom. Thanks for your time, guys. I appreciate it, and hope to see you in the trading room. And also subscribe to that newsletter. It's free. So thanks for your time, guys. Take care.